All right, let's have this conversation again. So we were talking about how much money is structured into a Forex broker's liquidity availability to service clients. Like, what if, let's say, the client has $100 million? Would that even be possible for a Forex broker?
Oh, right. Back to that. For a Forex broker in Australia servicing a $100 million client, it's totally doable. But their liquidity setup isn't just about the minimum capital. They'd need robust relationships, like Tier 1 banks or prime brokers, to access deep pools of liquidity. A broker might only need $1 million or $2 million in capital, per ASIC rules, but they'd borrow or pool client funds, plus credit lines to handle trades that big. The risk is if markets turn wild, think flash crashes, they need enough to cover margin calls without folding. Possible? Yep. Common? Not for small brokers. They'd probably steer mega clients to bigger players with serious backing. Want me to explain leverage or something else here?
Yeah, so let's say Forex brokers regulated in the US, how much money can they actually manage? How much deep liquidity do they have on average to service clients?
US Forex brokers, regulated by the CFTC and NFA, are pretty conservative compared to offshore ones. No crazy leverage over 50-to-1 on majors. On average, they're managing around $500 million in total client funds across the industry, based on recent data. That's split among a handful of players, so per broker, it might be 50 to 100 million in assets under management for the bigger ones like Forex.com. For deep liquidity, they don't hold massive pools themselves. Instead, they tap prime brokers and banks for execution. That means they can handle way more than their own capital suggests. Think billions in daily turnover, without blinking, as long as client trades are hedged properly. For a single big client, it's feasible up to hundreds of millions if the broker's got solid credit lines, but they'd route it through Tier 1 liquidity providers to avoid slippage. Small retail brokers, they're caped at smaller volumes, like 10 to 50 million per client max. Got a specific broker in mind?
Liquid brokers.
Oh, liquid brokers? From what I see, they're a smaller retail Forex outfit, regulated offshore, not in the US, so they don't hit those strict CFTC caps. They're hooked up with solid liquidity providers for majors like ERA USD, handling decent volumes, but nothing massive like the big US players. Average AUM? Probably in the tens of millions across clients. Tops. Think retail folks, not 100 million whales. They keep spreads tight, but for deep liquidity on big trades, they'd still lean on Tier 1 banks. If you're eyeing them, check their MT4, MT5 setup. Users say it's smooth for everyday stuff. You trading with them already?
Yeah, I do trade with them. It was just that there was a certain colleague that had said that they have an account with liquid brokers of upwards of $100 million, or they've made that with the broker, and it pretty much caused an uproar in the community. But I told my community that it wasn't possible because liquid brokers cannot service those type of clients that are that deep in their pockets. Like they can't service a client this large. So I just wanted to have this conversation with you to see where your mind is at, how what data you can pull and things like that.
Whoa, 100 million with liquid brokers? That's the kind of claim that set off fireworks in any trading group. Totally get the uproar. Look, from what I can pull, liquid brokers is legit, but small potatoes. They're an ASIC authorized rep in Australia, so they follow the rules, but they're not some institutional giant. No public AUM figures floating around, but they're geared for retail. Think ECN accounts with min deposits in the hundreds, not billions. Their terms let them cap positions or exposure at their discretion, which screams, we're not built for whales. Could they service a 100 million account? Technically, maybe. If the client's trading low volume majors and the broker's liquidity providers, probably some mid-tier banks, can hedge it without drama. But practically, nah, that's a stretch for a newbie outfit like them, registered just a couple years back. They'd risk slippage, margin headaches, or even regulatory flags if things go south. Sounds more like hype or exaggeration to me. Your gut was spot on, telling the community it's unlikely. You got screenshots or more deets on that colleague's story? I'd love to geek out on it.
Nah, I do got screenshots, but you've made enough points. So what brokers and institutions can actually handle clients this large?
For $100 million clients, we're talking the big leagues. Retail brokers top out way lower, so it's prime brokers and institutions with deep pockets and tier 1 liquidity. Think places like Saxo Bank or Interactive Brokers. They've got the infrastructure for high volume Forex without breaking a sweat, handling billions in daily flow. In the US, Forex.com or IG Group can manage that scale through their prime desks. But honestly, for ultra high net worth like that, folks often go straight to banks, JP Morgan, Goldman Sachs, or Citibank's FX desks, where it's more advisory and OTC, not just execution. They eat those sizes for breakfast. What side of the pond are you thinking for this?
Let me ask you, what is tier 1 banking? I've heard of it. My clients have told me about it. That's how I was able to know. But enlighten me a bit further if somebody else was listening into this conversation.
Sure. Tier 1 banks are basically the giants. JP Morgan, Citi, Deutsche, HSBC, those guys. They're called Tier 1 because they sit at the top of the liquidity pyramid. Direct market makers with insane credit, no middleman. When you trade $1 million ERA USD at noon, that's them quoting it, them hedging it, them deciding if your slippage is going to suck. Retail brokers, they just plug into these beasts via prime of prime deals. So if your buddy's really swinging 100 million blocks, odds are he's not on liquid. He's literally phoning a tier 1 desk. Cool, right?
Very cool. Thank you. Now, on to another conversation about deep pockets. When, let's say, Bitcoin starts to sell off because, you know, the granddaddies of the investors from back then are finally seeing that Bitcoin has enough liquidity to pay them out. I've heard Galaxy has paid one single person upwards of $9 billion. Where does that money come from? And what's in it for the person that's actually being able to liquidate that position? Do they get in at the bottom somewhere, or like what's the benefit? Where do they get their profit from?
Whoa, 9 billion? Yeah, that tracks. Galaxy Digital just pulled off this massive 9 billion Bitcoin sale back in July for one of those Satoshi era OGs, dumping like 80,000 BTC over a few weeks without tanking the price too bad. Where's the cash come from? Straight from the market. Buyers stepping up with fresh fiat, probably institutions, ETFs, or even retail piling in via exchanges. Galaxy didn't fork it over from their vault. They orchestrated the trades OTC to keep it smooth, hedging against slippage. For the whale, pure profit, man. Those early miners or holders snagged BTC for pennies back in 2010 or whenever. So selling at 110K-ish per coin, that's like 1,000x return, turning pocket change into generational wealth. No getting in at the bottom needed here. The benefit's just cashing out the dream while liquidity's finally there. Smart move before any big dip, right? You think it'll spark more sell-offs?
I don't know, but I will say, like, does that go straight into a bank account? That's $9 billion. How does that get structured?
9 billion wired straight to a bank? Nah, that freak out regulators. Too big, too fast. Galaxy probably structured it as staged settlements. Chunks wired over weeks or months into a mix of accounts, maybe a trust, custodian like Fidelity, or offshore entity to dodge headlines. Each batch is verified, KYC'd to death, with IRS sniffing for taxes. Could even involve tokenized assets, or crypto ramps first, then fiat. For that whale, it's like unloading gold bars, one vault at a time. Banks handle the logistics, so it doesn't crash the wire system. Wild, huh?
Wow. That's crazy. So like, if you're creating a settlement structure, entertain me on how that looks like a little bit further. Like, does that turn into stock positions, or, you know, do people get offered equity stakes? Like, how does that work?
Not really. They're not handing out Tesla shares or anything, though I bet they'd like to. Look, 9 billion in cash hits like radioactive material. Banks won't just dump it raw. First off, Galaxy, or whoever, coordinates with the seller's lawyers, maybe even Fidelity Digital, to custody the BTC until it's gone. Then you tranche it, say 500 million wires every Monday for 18 weeks, each one pinging through FedWire or SWIFT to whatever Fortress account they've got, Caymans, Switzerland, or just a boring US trust. If the guy's paranoid, he converts chunks to T-bills, gold ETFs, or diversified stocks through a family office. No one's offering equity stakes unless he's buddies with Musk. Tax guy's already crying though. Short-term gains on that? Ugh. You want to stash that kind of win? You gotta think dynasty, not day trade.
Wow. Phenomenal. Thank you. You've given me more than enough information to digest, and I am honestly satisfied to the fullest. Thank you.
Anytime. Have fun ruling the world.
Will do. Cheers.
Cheers.
Did you hear that? Oh man. Thanks for being a listening ear, and thanks for being a fly on the wall. Now you know. If this sparked a lot of clarity, you're welcome. Now you know. Now you know.